So I had a few questions with respect to the disconnect that we see at times from the prices point of view with respect to the economy. So I'll have a few very quick questions for you. So the first question is that is it possible to have a zero or a negative beta for a stock or an industry per se?
So it's difficult to have stocks with zero beta or a negative beta. It's possible to have industries with a zero beta or negative beta. So what I'll tell you is this. There's something called business beta or accounting beta, and then there's something called stock beta.
Business beta and stock beta.
Stock beta.
All right.
Business beta is basically comparing the growth in the cash flow from operations of a company with the growth in the GDP of the economy.
So sensitivity of the cash flow, CFO, or the profitability part with respect to the changes in the macroeconomic
represented by the GDP
of the country.
Right.
All right.
And you know how stock beta is calculated, right?
So stock beta becomes, just for the students, stock beta again is your sensitivity of the stock price with respect to the market.
Index.
And market again is also a barometer. Again, it's not representing exactly GDP,
correct,
but it's a group of stocks put together.
It's an approximation. It's an approximation. So what I'm trying to say here is that, if you focus on accounting beta, right,
okay,
or this business beta, you can clearly identify businesses which will have zero beta.
Okay.
Healthcare, FMCG.
Correct.
Right? These are products which are non-discretionary consumption. That's not going to stop. It is zero beta.
Healthcare to a larger extent than FMCG.
Even more than that. Yeah. So maybe FMCG is 0.1 beta. Healthcare is zero beta. Because see, if you have 5,000 rupees in your pocket and you need to buy one paracetamol strip, you're going to buy one paracetamol strip.
Right.
Now tomorrow if you had 5 lakh rupees in your pocket, just because you have more money, you're not going to buy 100 paracetamol strips.
Right.
You're still going to buy one paracetamol strip. Similarly, if you have 500 rupees in your pocket and you need one paracetamol strip, you're going to buy one paracetamol strip. It's non-discretionary, non-price elastic, zero beta consumption. Right.
Another uniqueness of the pharma industry.
And at the same time, if you look at the stock prices of some of the healthcare companies, some stock price will be 0.8 beta, some will be 0.6 beta. See, you're putting a mathematical equation there.
Because again, people react. People again are following the dog.
Yes, exactly.
And not the man.
So the business is going to grow, right? The man is going from point A to point B.
Right.
Today, India spends 3.5% of its GDP on healthcare. Brazil spends 9%. Okay. So we are at $2,000 per capita GDP. Brazil is at $9,000. In 15 years, if India's GDP grows at 10% per annum, we'll be at $9,000 per capita GDP.
And with Ayushman Bharat.
That's possible. And today, Indians spend $73 per capita on healthcare. Brazil spends $800 plus per capita on healthcare. So if next 15 years, when you do the analysis of this, in next 15 years, if Indian GDP grows at 10, Indian healthcare spend will grow at 18% per annum.
Okay.
To arrive at where Brazil is today.
Right.
So it's because it's a leverage on the growth of GDP, right? So last 10 years, Indian GDP growth has been 5, Indian health market growth has been 7.5. Right? So you have to understand that the man is just walking in a straight line.
Correct.
Now the stocks might do their own bit, but if you're following the man, it's just very simple to understand.
So even when you're looking at an industry which is not cyclical per se,
right,
still the equity beta or the stock beta is going to be non-zero.
Absolutely.
It's going to be there. But it's a business beta
because it's a mathematical equation of two numbers, no?
Right.
There will be an answer there, right?
And the numbers are reacting based on how people are behaving.
And how people are behaving.
So do you feel that in the current market scenario, does the efficient market hypothesis hold? Are the markets efficient?
In the long run, always yes. In the short run, rarely ever. Right? See, in the long run, what has happened to the Indian economy in the last 10 years? We have grown at 5% compounded return. Right? And last 10 years, stock markets have given you better than that return in India. So clearly, we are reflecting the growth in the market. GDP is a top line number. Stock market depends on the bottom line. So obviously, we have grown faster than the top line. And that is how, you see the stock market. So long run, always efficient market. Short run, rarely ever, because there's so much noise, so much that influences the stock returns and the stock prices every day, it can rarely ever be efficient.
So do you believe that the Indian market is kind of 10 to 15 years behind the US market? So normal observation says with respect to the economy, with respect to the lifestyle, consumerism, etc., we're kind of lagging about a 10 to 15 year kind of a time frame with respect to the US economy. Yeah. So do you see that with respect to the stock market as well?
I do feel that we are 10 years behind these developed markets simply because we don't have the same variety of products, we don't have the same financial literacy, financial inclusion that those markets have been able to achieve. We are just not there yet. But yes, COVID has accelerated our journey to that side.
Right. With the inclusion
bit at least, and the digitization of financial, inclusion. So I think COVID has accelerated us on that path, but we still remain a decade behind, I think.
So on that note, has there been a shift in investment strategy or the fundamentals or the way you look at it in terms of pre and post COVID world? I'm not sure whether we are in the post COVID world yet, but nevertheless.
So yeah, there has been some shift, right? You have to evolve with the times. See, fund management also has to evolve. So the shift has been that, we are now looking at each and every business and asking ourselves the question, can digitization disrupt the business?
Okay.
Or can digitization accelerate the growth in the business? Or decelerate the growth of the business? Or substitute the business model completely?
Dr. Lal versus a 1mg.
Exactly. Dr. Lal versus a 1mg was a classical example we spoke of. So we don't know the answers yet, but clearly the framework has evolved since COVID. Digitization has become a very important element of analysis, and pre-COVID it wasn't just as important element of analysis.
So do you also see the role of FIIs diminishing in the Indian markets?
Yes.
Of late, based on what we've observed,
Yeah. So data would suggest it has because they have been on a selling spree for a very long time now, and we haven't seen market the nosedive the way they used to whenever FIIs used to sell.
Right. True.
Historically, they used to sell. But that again is a function of the financial inclusion we are experiencing at this stage, where DIIs just have more money, more muscle in the market, and they are able to sort of buy when these FIIs are selling.
And just a while back, with the kind of interest rate and inflation, it was just not making sense to invest in anything apart from equity.
Exactly. And even if you look at these FIIs, right, so they may be selling today again because an average Indian investor today is selling small and mid caps and buying large caps.
Correct.
Because he sees turbulent times ahead, so he feels small and mid cap business models are fragile, God knows what will happen, and he buys the large cap and he feels safe there.
Mm-hmm.
Similarly, the FIIs are doing the same thing in their own context. They are buying developed markets and they are selling emerging markets because they know world turbulence is coming. So they don't want to be in emerging markets which can be more volatile, and they want to be in developed markets which are more stable. Okay, they'll do that. But once all these variables, this inflation, interest rate, war, once all of them stabilize, right? Once the world is back to normal, which can happen in 6 months, 12 months, 24 months, anybody's guess. But once that happens, then these guys have really no alpha to make by staying 100% invested in developed markets. Their alpha really comes when they invest in emerging markets and the emerging markets perform. So in a stable world, that money is going to come back. Now when that money comes back, if the level is, let's say, lower, they benefit because they've been able to push it lower before when they went out. And if that level is then high and then they come back, then these guys are going to drive the level even higher, because at that time, DIIs won't be selling. They'll also be buying. So you can imagine the technical push that the market can get at that point. See, people want to judge the markets today. What have you seen in the last 12 months? You've seen an international war. You've seen an international pandemic. You've seen international hyperinflation. You've seen countries getting bankrupt, defaulting. You've seen countries under lockdown, no ports, no transport, no labor movement. And if you have gone through all of that, and if you are seeing equity still reasonably holding up, that gives you a lot of indication.
Still above the pre-pandemic levels.
Still above the pre-pandemic levels. So then you know what's going to happen when all these issues get resolved. You are looking, probably in my personal view, you are looking at a very big bull run once the market stabilizes. Once these macroeconomic variables stabilize.
So when we're looking at these valuation space, has private equity valuations and the kind of investments that has gone into this asset class, has that kind of impacted the liquidity or the money that could have flown into the listed space? For example, when we again looking at Tata buying Big Basket or Thyrocare being bought by Pharma, with the kind of scale that we're looking at in the private equity space, has that anyhow impacted the valuations in listed space?
So no, I don't feel so. I think, one, the liquidity is not impacted because the money that goes into private equity is a totally different kind of money. That's probably not going to come to public equity.
Okay.
Right? So private equity players get a majority of their money from UHNIs and institutions which want to lock in money for 10 years from investment and don't want to look at that money for 10 years. That money is not going to come to public market even if it doesn't go into private equity. But yes, the valuations read across is always there. So if somebody buys a diagnostic lab for 20 times sales and the current diagnostic labs are selling for 10 times sales or 8 times sales, then people will start making comparisons and start saying, why does that lab deserve that kind of a premium in that private market? Why does this lab not deserve that? So that those reader process keep happening, and people keep taking their own inferences, whether that was an expensive deal or is this cheaper. You can make both inferences from the gap of valuations. But yeah, so those comparisons we keep happening on and off. But it's not that the fund flow would have affected the market.
Nothing as such.
Nothing as such.
Alright. The next question I have is that when you're looking at IPOs, and we've seen quite a bit of IPOs and contentious IPOs, if I could say so, wherein the target price while getting the IPOs listed was something else, and immediately few months down the line, the target prices by the same bankers who came with the IPO has been revised to almost 50% of that. So given that question, how does an investor look at the IPOs? Or how does an investor decide as to which IPO to invest in?
So I'll give you my framework. There's no right or wrong answer here. I mean, there are multiple ways of doing the same thing. The way I look at it, I generally don't give money in IPOs to those investors where it is just a private equity exiting the company. It's a secondary offering. Okay. Because if a private equity who owns 25% in a company wants to sell it to me, and he has been invested in the company for 10 years, he knows more about it and he's selling it, then why should I be buying it, right?
Okay.
So when the guy who's most knowledgeable is selling, and if I am the less knowledgeable guy, why should I be buying from the more knowledgeable guy? This doesn't make sense to my head. So therefore I don't generally apply for IPOs where companies, it's a secondary offer.
Okay.
I want to generally apply to those IPOs, if everything else is okay, apply to those IPOs where they need the money to expand capacity, they need the money to establish another product.
So the money is being invested into the business. In that case, I want to go for the IPO.
Exactly.
Of course, the other factors remaining positive.
Positive.
And if it is just to load off their shares, then we're probably not going to be interested.
Yeah, then they're probably just trying to...
Or at least it's a major red flag.
Exactly,
over there.
it's a big red flag, generally.
Okay.
And I generally try to avoid companies where there is no cash flow. Right. So for me, and so that principal sense of investing, when you buy an asset, you are buying future cash flows.
Correct.
So there should be future cash flow.
That's the basic premise of valuation.
Basic premise of any security valuation.
Correct.
So businesses which are burning cash,
right?
You need to have a very, very strong and convincing view that in 4, 5, 3 years, they start generating cash.
You can change the consumer behavior totally.
Totally. And you as an analyst or as an investor need to have a very convinced view on that, to buy that. I just don't think people thought of it in that fashion when they applied to some of these new age IPOs. And that is why they're burning their hands today. They may be right, after 5 years, these stocks might actually become big successes because they're able to change consumer behavior and they're able to become, profitable. They may be right, but it was just too soon, I guess. And again, equity, when you buy any equity, you buy volatility, right?
Right.
So if you're buying into these IPOs and you're buying volatility and then the price is becoming volatile, don't get perturbed. Just go back and recheck your decision. Was it a right decision? If it was a right decision, be arrogant, stand in the face of the market, tell them I'll take it with, from you for 2 years, but then it will be my turn. Or if you're wrong, then just go and apologize to Mr. Market, cut your losses and say, look, I've learned my lesson, I won't do it again.
So you need that depth and that understanding and that thoroughness
with your
360-degree POV, POV, the point of view. So perfect. One more question. So when you're investing in a company, do you have any kind of a preference with respect to that this company is managed by the promoters, or I would prefer a company wherein the management is absolutely independent of the promoter family? Do you have any kind of a...
No, we generally don't.
Bias?
No, we don't. So basically we want 3 things from our management, principally speaking. We want integrity, we want honesty, and we want competence.
Okay.
Right? So, and there are ways to judge whether they are competent, whether they are being honest, and whether they have integrity in the way they deal with their business partners. So for instance, if you want to look for, let's say, honesty. So you look for the books of accounts, right? So you get your annual reports, you have their financial statements, you run a few forensic ratios. Let's say you run a ratio like CFO EBITDA. Right. Now let's say this is a particular company does CFO of 60% compared to the EBITDA. So CFO EBITDA is 60%, 5-year average. And then you take another 5 companies in the same subsector and you compute their CFO EBITDA. And if you see that the 5 peer average CFO EBITDA is 80%, but this company is 60%, then you need to be cautious and
figure out the reason.
There's a red flag there basically.
Right.
Let's say they have something called a business revaluation reserve on the balance sheet.
Okay.
Right. Why do you need a business revaluation reserve on your balance sheet? Why do you have it? Question then. Let's say another ratio which we oftenly compute is the company showing that they have cash at the end of the year of 100 crores. When you look at interest income, it is 20 lakhs
Okay.
for the year. So if you have 100 crores
The
of cash,
consistency of the cash flow throughout the year.
exactly. So
Right.
if you have 100 crores in your cash and you have had it for 12 months, you would have had at least 3 to 4 crores of interest
So basically,
income.
the interest income would give you the average cash balance you maintain throughout the year, and then
Either
compare
that
it with
or that
the-
100 crores isn't really real.
Correct. It's just your
It's just
managing
an
of
imaginary
books.
number.
Yeah.
Right? And we have had companies where
So how important does the forensic accounting or the forensic financials is in your analysis while choosing a stock?
was the first step.
Okay.
See, when I started the healthcare product that I just currently manage, we started screening 190 companies,
Okay.
190 healthcare companies, of which only 70 made the cut.
7-0.
70. So only 70 companies are eligible to be in the portfolio.
Okay.
Forget about valuation, business structure,
Right.
everything else. The other 120 are not eligible to be in the portfolio.
Perfect.
Now that I know I can analyze only 70 companies, my vision is now more
Right.
focused and concentrated. Now on these 70 companies, I divide them in subsectors, diagnostic, hospital,
Right.
and branded generics, and then I know which are the right companies to follow and analyze, and I make my investment. So 18 of these companies went into my portfolio, but it's 18 out of 70, not 18 out of 190, because 120 I know I'm never going to invest in because their accounts don't make sense.
Okay.
So when the accounts don't make sense, then there is no honesty, integrity.
So forensic financials would start with ratios and comparison with the industry or the peers.
Yes.
And then trying to justify or get an answer to it.
Yes.
If you have a very reasonable justification, it might be acceptable.
Absolutely.
Otherwise, that's discarded,
It's discarded.
for good.
Absolutely.
And that becomes, so forensic kinds of becomes your stepping stone or like a screener. It works like a screener.
It's a screener. So, see, when making a portfolio, you can make two types of, or when investing, there are two types of errors you can make. There's sampling error 1 and sampling error 2.
Okay.
Sampling error 1, you buy everything, you'll end up buying a few bad apples.
Right.
Sampling error 2, you buy very few, you'll end up missing some good apples.
And it's better to do the latter.
Exactly. So I am the person who believes in error 2 rather than doing an error 1. I'll create a concentrated portfolio for myself, few stocks. I'll miss out on a few good stocks. I'm happy and okay with that. As long as every stock that I pick is a very good, happy stock.
Right.
And I would rather not buy 100 stocks and be wrong on 20. I would rather buy 15 stocks and right on all 15 or at least 14, 13.
Makes
Right.
sense.
So it's error 2 rather than error 1 for me. Some
Nice.
guys would have the style 1. So individual choice. So my choice is error 2, not error 1.
Perfect.